The difference between VXX and VIX lies in their core aspects. VXX is a special form of investment product that replicates the VIX futures for the short term, essentially showing a snapshot of potential future changes to the VIX index. It can be bought and sold like stocks, providing an image of potential volatility. On the other hand, VIX follows the volatility index, which indicates the extent to which market participants expect a change in direction during the next 30 days. This tool is often referred to as the fear index, as it reveals the level of concern among investors and their expectations for market price changes, making it preferable for market forecasting. During times of rising volatility, VXX often performs well, but it may underperform during longer periods. In contrast, VIX is closely linked to market volatility, frequently spiking during market downturns, which indicates a greater demand for options among investors seeking protection from market falls. The VIX's performance is regulated by aspects like roll yield and the VIX futures curve, making its market conditions more stable for investors in terms of risk and profit return. The short-term VIX futures volatility affects VXX, and if not properly managed, this exposure may result in increased volatility and lost potential, making it riskier. Additionally, roll yield and time decay may hurt its value over time. In contrast, VIX is a real-time market index. Despite its high degree of volatility, and its index tracking features provide a more stable estimate of market volatility, making it less risky over the long run. Therefore, VIX provides less risky returns over the long term. Despite their differences, both VXX and VIX track the movement of the S&P 500 index, with their value rising when the market is on a downturn for extended periods. This makes them helpful in protecting investments during turbulent market conditions. Ultimately, while VXX may offer higher returns during volatile sessions, it is riskier and easier to lose investments. In